What we are seeing today in the stock market is actually very concerning. The bond yields are plummeting, the dollar is plummeting, but the stock market cannot seem to stay in green territory. Why is this so big? Well, we're going to discuss it here in this video, guys. We're also going to be talking about the data coming out tomorrow and how that also could affect the market. So the only thing I ask you guys to do is hit that like button and subscribe to the channel if you like these kind of videos. If you want the stock market to go up or down, give me your comments on that down below in the comment section. But first things first, let's talk about this dynamic that should not be happening in the markets, which is a little bit worrisome, and kind of why it's worrisome. So if you look at TLT, this is the 20-year treasury, but you could look at the 10-year bond, you could look at anything. All of the yields are going down today, and I guess maybe we should just look at CNBC and just pull up the bonds. You will see that the 10-year treasury is down 16.5 basis points, which is a big move on the day. And typically what you have seen in 2022 is when bond yields fall, the stock market rises, as it does help valuations when yields go down, when interest rates go down lower, because that's essentially what is happening. When bond yields go down, interest rates are going down. The cost of capital is easing a little bit. It's easier to get mortgages, things like that, right? So you should see a stock market that is up today, not in the red. And at some point today, the markets have been down 0.5%, whereas at the same time, you also have the dollar, which is down 1.12%. And typically when the dollar is down like this, that is also a bullish thing for the markets. But that's not happening today. Why is that not happening, and what is the real concern here? Well, the price of oil, commodities, they have been falling for different various reasons, and a lot of people have pointed to those various reasons to why they are going down. But in all reality, you might be seeing bond yields going down. Commodities like oil, have you got gas recently at the gas pump? Well, it's been a lot cheaper. Maybe all of this is happening because of a recession. During a recession, oil goes down, commodities go down, bond yields go down, the cost of capital gets cheaper. And that's the real concern here, because if this is happening due to a recession, well, the markets are not prepared for that. The markets are still, on a PE ratio, they're still overvalued. And economists still have the stock market, the S&P 500 more specifically, growing earnings about 5% next year. And if we go into recession, if you are seeing these moves in the markets because we're going into recession, well, that is obviously not going to happen, and that is going to be a big shocker for the stock market once those earnings go down and once those numbers actually come out. So this move that we're seeing today is a little bit concerning. In my personal opinion, the stock market, just based off of what we have seen in 2022, should be up at least as much as the bonds and the dollar is down. And when you look at how much the dollar is down today, the dollar's down 1.14%. The bonds, TLT, is up 2%. You should be somewhere in the middle, right? Up 1% at the low end, up 2% on the high end. You're not even close to that. The S&P is still in negative territory, but at some point today has been in very negative territory. So very, very concerning what we are seeing happening in the markets today. Now, if we do go ahead and look at the data that came out today, it was not all too bad. The key inflation measure that the Fed follows rose 0.2% in October, less than expected. The core personal consumption expenditures price index rose 0.2% in October, slightly below the estimate. The index increased 5% year over year. Personal income jumped 0.7% for the month, well ahead of the 0.4% estimate, and spending rose 0.8% as expected. Weekly jobless claims totaled 225,000, a decline of 16,000 from the previous week, and below the 235,000 estimate. Outplacement firm Challenger, Gray, and Christmas reported that planned layoffs increased 127% on a monthly basis in November and were up 417% from a year ago. So you're getting more of these layoff statistics. You are getting core CPI that is going down, right? It's going down more than the market's expected, and yet even on top of all of that, you're not getting a positive reaction. Again, a little bit concerning. Now, we must talk about the economic data that will be coming out tomorrow that definitely will have a big impact on the markets. And first thing is going to be the unemployment rate coming out at 8:30 in the morning. This is the unemployment rate for the month of November. This is just the headline number that you'll hear during recessions is like 10% or whatever for your state, right? A lot of people lived through the 08 recession. This is that number. It will come out tomorrow at 8:30 in the morning. The forecast is for 3.7% unemployment. That was the previous reading that we got, so didn't really move. And it takes a lot to move the needle on the unemployment rate. So if this goes up or down, it's not going to be by a big degree. And if we get an unemployment rate of 3.8%, that's going to be a positive thing for the markets. If the unemployment rate stays at 3.7%, I don't expect a huge reaction in one way or another. If the unemployment rate goes down to 3.6%, it's going to be all hell's loose for the stock market. I don't think this is what is going to give us the big move, though. I do think the non-farm payrolls also coming out at 8:30 in the morning and for the month of November, that could give you a bigger move. And we are expecting 210,000 jobs to be added to the economy. And why I think this could give you a bigger move is because I think the data can move around a lot more. I think there's a chance this thing comes in at 150,000 jobs that are added. You know, that would be 60,000 less than expectations, and that would be massively bullish. On the other hand, I do think there is a chance that you come in higher than 210,000 jobs. We have had big surprises to the jobs report before. We've had huge surprises to the jobs report before to the upside. So I think there is, you know, and not to put statistics on it, but I think there's a 50-50 chance that this either comes in well under or well above the expectations. I don't really expect it that economists have it right. I do think they're going to be wrong, you know, whether it's going to be bullish or bearish, higher or lower. That is the real question. Last month, we gained 261,000 jobs. So just from what we've heard over the past, you know, month or so is a lot of layoffs. I kind of am leaning towards a positive reaction in the markets. I'm kind of leaning towards less jobs to be added than 210,000. But again, we've thought this before in the past, and you know, it's gonna give you a big move. It's gonna give you a 2 to 3% move in the stock market, depending on this number. And a lot of big money, as you will see if you know anyone with the Bloomberg terminal, a lot of people over there are talking about the non-farm payroll report, and they're waiting for that to come out to really make their positioning and, you know, to like get ready for the next couple of weeks. You do have the next CPI report coming out December 13th, so believe it or not, just around the corner. And then you have the FOMC meeting December 14th. So these are going to be the last big data points, at least until the CPI report and the Fed meeting, for the markets to figure out, you know, do we want to be bullish, do we want to be bearish right now. I will tell you, seasonality of the stock market this time of the year tends to be very, very bullish. Now, if we do look at the technicals that we have had drawn out, we did break above this descending level of support. It's pretty clear here. 1, 2, 3, 4 touches to this. If you get rejected, it's probably going to be pretty bad to the downside. And you can see I have a small put position on my portfolio, one S&P 500 394 put for December 16th to play this potential crack. I'm not convinced on it, so that's why you only see one. It's not a lot of options, but you know, I do want to have some downside protection here in case we do get rejected at this level coming tomorrow. And I think the positive thing is you will know if you get rejected off this level tomorrow, or you will know if the rally is going to continue coming tomorrow. We are now above the 200-day moving average. This is something that we have not seen since, what is this, March of 2022, so it's been a long time, and that is a positive factor. But I think you need to break out of this technical pattern to really get a lot of momentum to the upside, because after all, 80 to 90% of the trading volume you see on any given day is done by trading algorithms that are mostly trading off of technicals and off of news. So if you do get a negative report tomorrow, I think it's very possible you could fall to 390 on the S&P 500, which is more in line with the actual fundamental valuation of the stock market right now. You know, where we're sitting at right now with the S&P at almost 410. It's not accounting for recession risk. It's not really accounting for any more risk. It's you know, richly valued at those prices, given the federal funds rate is going to remain higher for longer, guys. So that is it for this video. Hit that like button, subscribe to the channel if you learned anything. If you like my perspective here and you want to stick around a while, I do greatly appreciate it. It does help out the channel immensely. But nonetheless, the most important thing you can do is enjoy the rest of your day, and I will see you in the next one.